Welcome to the deep dive. Today, we're really getting into something important for a lot of people's financial future in India. We're talking about the Employees Pension Scheme. 1995, you probably know it as EPS 95.
That's right. It's a government scheme set up under the Main Provident Fund Act of 1952.
And our mission, really, for this deep dive is to cut through some of the complexity. We want to give you a clear picture.
Exactly. We'll break down, who's actually covered by it, how the whole thing works financially, and crucially, what benefits you might actually get from EPS 95.
Yeah, make it understandable. We're working directly from the official scheme documents here, so this is straight from the source. Now, EPS 95 officially started November 16th, 1995. But there was this interesting bit, right? People could opt in retroactively.
Yes, that's right. There was an option to join going back to April 1st, 1993, though, that depended on the specific rules back then.
Okay. And its reach is pretty wide, isn't it?
Oh, absolutely. It covers employees in, well, loads of different workplaces, factories, other establishments, basically any way that falls under that main 1952 Act.
So if you're in the organized sector, this is likely something relevant to you.
Definitely relevant.
Okay, before we dive deeper, let's maybe define a few key terms, just so we're all on the same page, build that foundation.
Good idea. Laying the groundwork.
First off, when we say the Act, we mean that big one. The Employees Provident Funds and Miscellaneous Provisions Act, 1952. That's the parent law.
Right. And then there's actual service. This is pretty much the total time you've worked from November 16th, 1995, or whenever you joined a covered job, if that was later, right up until you leave.
Yeah.
Your total employment time.
Got it. And slightly different is contributory service.
Exactly. That's the part of your actual service where pension fund contributions were actually paid, or importantly, should have been paid for you. This is what builds your pension rights.
Okay. Makes sense. Then eligible member.
Simply someone who qualifies to join the scheme. Straightforward.
An existing member. That's a specific group, right?
Yes, those were the folks already in the older Employees Family Pension Scheme, the 1971 version. When EPS 95 kicked off, they were transitioned over.
Right, the transition group. Now, family, who does the scheme count as family?
Okay, so for a male member, it's his wife and his sons and daughters. That includes legally adopted children, too.
And for a female member?
Same logic. Her husband and her sons and daughters, again, including any adopted children.
Okay, and pension itself, it covers more than just the EPS 95 payments.
Yeah, it does. It includes the monthly payments under EPS 95, but also any family pension payments that were already happening under that old 1971 scheme right up until November 15th, 1995. So carried over some existing benefits.
Right, a continuation. Now, a member is just anyone who joins the EPS 95 fund.
Pretty much, yes.
Yeah.
Anyone who joins according to the rules. But a key point here, membership usually stops at age 58, or if it happens sooner, the date your pension benefits actually start.
Tied to retirement age or benefit start date.
Okay. Then you've got non-contributory service. As it sounds, it's any part of your actual service where no pension contributions were made or required. That time doesn't count towards building the pension amount directly.
Okay. Orphan, fairly clear. A child with no living parents.
Correct.
And past service. That's linked to those existing members again.
Exactly. It's the service they racked up under the old family pension fund up to November 15th, 1995. This gets factored into their total EPS 95 benefit.
Got it. Pay, what's included in pay for this scheme?
It's specifically defined as your basic wages, plus any dearness allowance, any retaining allowance, and also the cash value of food concessions. That's part of your deal.
Okay, so not just basic salary. Good to know.
Pension fund is simply the employee's pension fund set up by the Act.
And pensionable service, this is the crucial one for calculations, right?
Absolutely. It's the service period where contributions were received or were receivable into that pension fund. It's the core metric for your pension amount.
Okay. And lastly, permanent total disablement.
Right. This has a specific meaning. It's a permanent disability that stopped you from doing any of the work you could do when you became disabled. And importantly, it doesn't matter if the disability happened during work or not. It's about your capacity.
Right, the capacity to work, that's clear. And just a final point on these terms.
Yes.
If a word isn't defined in the EPS 95 scheme itself, it just takes its meaning from the main 1952 Act, correct?
Exactly. There's always that link back to the primary legislation.
Okay, great. So foundations laid. How does this pension fund actually get funded? Where does the money come from?
Well, the main chunk comes from the employer side. You know, the employer contribution to your regular provident fund, your PF.
Yeah.
Okay, so 8.33% of your pay out of that employer's PF contribution gets diverted into this employee's pension fund.
Ah, so it's carved out of the employer's PF share.
Precisely. But it's not just the employer. The central government chips in too. They contribute 1.16% of the members' pay directly into the pension fund.
So employer and government contributions combined.
Correct. But, and this is a really important but, there's a ceiling on the pay used for these calculations.
Ah, the wage ceiling.
Yes. Currently, both the employer's 8.33% and the government's 1.16% are calculated on pay up to a maximum of 15,000 rupees per month.
So even if you earn more, the pension contribution is only based on that first 15,000.
That's the standard rule, yes. That cap significantly affects how much goes into your pension pot, especially for higher earners.
Right. And what happened to the money from the old scheme?
Good point. When EPS 95 started, all the net assets from the old Employees Family Pension Scheme, the 1971 one, were transferred over. So it didn't start from scratch.
Inherited the old fund. Makes sense.
Yeah.
And who's actually responsible for making sure these payments happen?
The buck stops with the employer. The scheme makes it clear. The employer has to pay the contributions for all their eligible employees.
Even if they hire people through, say, contractors?
Yes. Even then, the primary responsibility lies with the principal employer.
Okay. And there was something about support for employees with disabilities.
Yes, there's a provision where, for employees covered under specific disability laws, the central government pays its 1.16% contribution directly for up to 3 years from when they join the fund. A bit of extra help initially.
That's good. Now, what if an employer doesn't pay on time? Are there penalties?
Oh, yes. There are damages, as the scheme calls them. It's basically a penalty interest rate.
And it increases the longer the delay.
Exactly. It starts at 5% per annum for short delays, but can go up to 25% per annum if the default lasts 6 months or more. So real consequences are employers not meeting their obligations.
Okay, definitely an incentive to pay up. Yeah. Let's switch to membership then. Who actually gets into this scheme?
Right. So from November 16th, 1995 onwards, it was automatic for a couple of groups.
Who?
Firstly, anyone new joining the main Provident Fund scheme or an equivalent exempted fund if their pay was 15,000 rupees or less when they joined, they were automatically in EPS 95.
Got it. New PF members below the ceiling. And the second group?
That was everyone who was already in the old family pension scheme, 1971, right before EPS 95 started. They were just automatically rolled over.
Seamless transition for them. Were there options for others to join?
Yes, there were. For instance, if someone had left the old family pension scheme between April 93 and November 95, they had a window to opt in to EPS 95.
Okay. And what about people who were in PF but not the old family pension scheme?
Them too. If you were a PF member on November 15th, 1995, but hadn't joined the family pension scheme, you also got an option to join EPS 95 from that date. Usually required following specific procedures, though.
Right. Procedures mentioned in paragraph 17, I think.
That's the one, yes. And remember what we said earlier about membership ending, typically at 58 or when benefits start vesting.
But you could potentially retain membership until 58, even if you stop working earlier.
Yes. The scheme allows retaining membership until 58 or until withdrawal, death, or pension vesting, whichever comes first. Offers some flexibility there.
Okay. Let's clarify those joining options a bit more. What about members who passed away during that 93 to 95 period?
Ah, yes. If a member had left the old scheme and then unfortunately died between April 5, 1993 and November 15, 1995, the scheme considers them to have joined EPS 95 on their date of death.
So their family could potentially claim benefits under the new scheme.
Exactly. It ensured continuity for benefits.
And for living members in that same boat, left the old scheme in that window.
They had the option to join EPS 95 upon leaving their employment, again, following the process in paragraph 17.
Okay. And likewise for those who were PF members but not FP members on November 1995.
Same deal. Option to join from that date per paragraph 17. So several pathways into this scheme were created back then.
Right. Now, what happens if there's, like, a dispute, if it's unclear whether someone is actually eligible to be a member?
Yeah, that can happen. The scheme has a process for that.
Who decides?
It goes to the Regional Provident Fund Commissioner. They make the final decision, but only after hearing from both the employer and the employee involved, ensures a fair hearing.
Okay, a formal resolution process.
Good.
Let's get into calculating service time. This seems really crucial for benefits. How does eligible service work?
It is crucial. Okay, for new entrants, people joining from November 1695 onwards, Their eligible service is basically their total contributory service.
The time contributions were made or due.
Correct. And there's a specific way it's rounded.
How so?
If your total contributory service includes a fraction of a year, say 7 months, that counts as a full year because it's 6 months or more. If it's less than 6 months, say 4 months, that fraction is just ignored for calculating total years.
Okay, round up from 6 months, ignore less than 6. What about seasonal workers?
Special rule for them. If someone works seasonally, any contributory service they have within a year counts as a full year of eligible service, even if it's just a few months.
That's important for certain industries. Now, for existing members, the ones from the old scheme,
For them, eligible service is their contributory service under EPS 95 plus their past service from the old 1971 scheme. You add them together.
but wasn't there a catch about contributions for that past service?
Yes, a condition. That past service only counts if any missing contributions from that period have actually been paid into the new employee's pension fund. The fund needs to have received the money for it to count fully.
Okay, makes sense. And the rounding rules are the same for them. 6 months or more rounds up.
Yep, same rule applies to the total aggregate service for existing members.
Got it. Now, pensionable service, is that different from eligible service?
Slightly different focus. Pensionable service is simply the service period for which contributions were received or receivable. It's the service years used directly in the pension amount calculation formula.
Okay. Eligible service for qualifying, pensionable service for the calculation.
You've got it. And there's a bonus, sort of, for long service.
What was that?
If you retire at 58 and you've got 20 or more years of pensionable service, they add an extra 2 years of weightage to your pensionable service total for the calculation.
So 20 years becomes 22 for the formula.
Exactly. It rewards longer careers within the scheme.
Nice benefit. Okay, next key element, pensionable salary. How is that figured out?
Right. This is the other big factor in the pension formula. It's defined as your average monthly pay over the last 60 months, the 5 years right before you exit the pension fund.
Average pay over the final 60 months. But you mentioned those wage ceilings earlier. How do they affect this?
Yes, critically. The pensionable salary itself is subject to those maximums, and it's calculated pro rata.
Pro rata, meaning?
Meaning, for service up to September 1st, 2014, the maximum pensionable salary used in the calculation is capped at 6,500 rupees per month.
Even if you earn more.
Even if you earn more. Then, for service from September 1st, 2014 onwards, that maximum cap increased to 15,000 rupees per month.
So the calculation uses the relevant cap for the specific period of service.
Precisely. It's a blended calculation reflecting the different ceilings over time.
What if someone didn't get full pay during those last 60 months?
Right.
Say, unpaid leave.
The scheme accounts for that. If you didn't get full pay throughout, they look at the average of the last 60 months where you did receive full pay and for which contributions were made.
And if there were periods with no contributions at all within those 60 months?
Then they calculate your average daily wage for the days you were paid in that 60-month period and multiply that daily average by 30 to get the monthly pensionable salary. It avoids penalizing for contribution gaps unfairly.
Okay, seems fair. Now, you mentioned some people were contributing on salaries above the old 6,500 limit before 2014.
Yes, that happened. And when the ceiling changed in 2014, there was a specific option created for them.
What was the option?
If you were already a member on SEP 1 2014 and contributing on pay over 6,500, you could make a joint declaration with your employer to continue contributing on your actual salary, even if it was over the new 15,000 ceiling.
And their pensionable salary could then be based on that higher actual salary.
Correct. It allowed some higher earners to potentially get a pension based on their full pay, not just the capped amount.
But there was a catch, wasn't there?
Yeah.
An extra contribution.
Yes. If you took this option, you had to contribute an additional 1.16% of your salary above the 15,000 ceiling. This extra bit came from your own employee PF contribution.
And there was a deadline to choose this.
Absolutely. Initially 6 months from September 1st, 2014, with a possible 6-month extension. If you didn't opt in by the deadline, any contributions made above the ceiling were basically refunded to your PF account with interest. You were assumed to be sticking with the standard capped contribution.
Okay, a time-limited choice with financial implications. Got it. Let's move on to the actual pension payout, the monthly member's pension. When do you qualify?
Right. The main one is the superannuation pension. You're eligible if you've got 10 or more years of eligible service and you retire at age 58.
10 years service, age 58. What about retiring earlier?
That's the early pension option. You still need the 10 years of eligible service, but you can choose to retire or leave employment before 58. However, you can only start drawing this early pension from age 50 onwards.
So minimum 10-year service and earliest drawdown age is 50 for early pension.
Exactly.
How is the amount calculated for, say, new entrants, people joining after November 95?
For them, the formula is quite direct. You take pensionable salary, multiply it by pensionable service years, and then divide the whole thing by 70.
Pensionable salary X, pensionable
Bang.
service, 70.
Okay. But remembering that pro rata calculation for the pensionable salary based on the pre- and post-2014 ceilings.
Right. The calculation uses the 6,500 cap for the service before SEP 2014 and the 15,000 Coglish cap for service after that date.
Precisely. It's blended based on when the service happened.
Now, what about the existing members, the ones from the old scheme? Is it more complex?
It is a bit more involved, yes. Especially for those whose pension starts later, say after November 16, 2005. Their pension is basically two parts added together.
Two parts.
Yeah. Part 1 is calculated using that same formula, salary X service, 70 for their service from November 16, 1995 onwards. But there's a floor for this part, a minimum of $635 per month if the formula gives less.
Okay, a minimum for the post-95 service part. What's part 2?
Part 2 is the past service pension. This is based on salary slabs from the old scheme and their years of service before November 95. This amount then gets adjusted by a factor from a specific table, Table B.
That factor adjusts for the time elapsed?
Kind of, yes. It takes into account the period between November 95 and when they actually leave employment.
And when you add these two parts together for these existing members, are there minimums?
Yes. For pensions starting after November 16, 2005, the total combined pension has a minimum of $800 per month if you have 24 years or more of total eligible service.
And if you have less than 24 years?
Then that $800 minimum is reduced proportionally, but it can't drop below an absolute floor of $450 per month, so there's a safety net.
Okay. And you mentioned similar but slightly different minimums for those whose pension started even earlier.
Correct. The scheme had different minimums set for pensions starting between 2000 and 2005 and before 2000. They were generally lower, reflecting the scheme's evolution. For example, 600 minimum, reducing to 325 for the 2000-2005 period, and 500 reducing to 265 before that, both assuming 24 years service.
Right. Historical context matters. Now, generally, when does the pension payment actually start?
The rule is it's payable from the day right after you turn 58. That applies even if you technically retired or stopped working earlier. Age 58 is the trigger date for standard pension commencement.
Okay. And that early pension between 50 and 58, you mentioned a reduction.
Yes, a significant one. For every year you start taking the pension before age 58, the amount is reduced by 4%.
So starting at 50 means a 32% reduction. 8 years, 4%.
Exactly. It's a big trade-off to consider if you're thinking about taking it early.
Definitely. Is there an overall minimum pension amount these days?
Yes, there's a general minimum monthly members' pension set at 1,000.
1,000 rupees.
However, that can be reduced if you took out a lump sum commutation or return of capital before a certain date in 2008, or, as we just discussed, if you're taking an early pension. So it's a baseline, but subject to those adjustments.
Got it. Can you delay taking your pension after 58?
You can. If you're eligible at 58, you can choose to defer starting it up to age 60.
And is there an advantage to doing that?
Yes. For each full year you defer after 58, your pension increases by 4%. This increase is also subject to the wage ceiling, but it's a way to boost your income if you don't need it right away.
So deferring for 2 years until 60 gives an 8% increase.
Correct. And if you actually keep working after 58 while deferring,
Can you still contribute?
you can choose to, yes. And those continued contributions can increase your pensionable service and potentially your pensionable salary, further boosting the final pension amount calculated at age 60.
So working longer pays off directly.
Right.
What if someone defers but then passes away before starting the pension, say at 59?
Good question. In that sad event, their family gets the family pension as if the member's own pension had started on the day they died. So the family is still protected.
That's reassuring. Now, what if you leave your job before you're eligible for pension, say before 50, or even after 50 but before 58?
Okay, if you leave after age 50 but before 58, you have a choice. You can either wait and start receiving the reduced early pension when you hit 50 or later, or you can opt for something called a scheme certificate.
A scheme certificate, what's that?
It's a document issued by the PF commissioner that basically records your pensionable service, your pensionable salary at exit, and the pension amount you were entitled to then.
And what's the use of that?
It's portable. If you later get another job covered by EPS 95, you can submit that certificate, and your previous service gets added to your new service period for calculating your final pension. It lets you combine service across different jobs.
Ah, so you don't lose the service history.
Exactly. And the scheme notes that people who take this route might also get the benefit of additional relief measures introduced later.
What about people with less than 10 years service who leave and then die relatively soon after?
There's a specific provision for that scenario. If you have less than 10 years service, leave the job, and die before 58 but within 36 months of your last contribution,
Yes.
then your contributions can be used to provide a monthly widow or children's pension, calculated based on Table C. If no widow, then orphan pension.
But only if death is within 36 months of the last contribution.
Correct. If death happens after 36 months in that situation, less than 10 years service, left job, under 58, then the family receives withdrawal benefits instead, as per paragraph 14.
Okay, that 36-month window is key there. Now, let's talk about those withdrawal benefits. What happens if you leave before getting the 10 years needed for pension?
Right. If you don't meet the minimum 10 years eligible service by the time you leave or hit 58, you can't get a monthly pension. Instead, you're entitled to a one-time lump sum withdrawal benefit.
How is that calculated?
It's based on figures in Table D of the scheme, but you also have an alternative if you're under 58 when you leave.
Let me guess the scheme certificate again.
You got it. You can opt for the scheme certificate instead of the cash withdrawal, keeping the door open to combine service later.
And the withdrawal amount itself, is it just based on final salary?
No, it's a bit more nuanced. It's calculated using a weighted average of your wages at the end of each different wage ceiling period you worked under.
Accounts for the changing ceilings over time.
Yeah.
And for existing members, is there anything extra?
Yes, those who came from the old 1971 scheme also get back their contributions from that past service period. This is calculated using Table A and then adjusted by that factor from Table B we mentioned earlier. Reflects their full history.
Okay, covers leaving early. What about disability? What if someone becomes permanently disabled while working?
The scheme provides crucial support here. If a member suffers permanent and total disablement during employment,
Yes.
they are entitled to a monthly disability pension calculated under the rules of paragraph 12. There's a minimum guaranteed amount of $250 per month for this.
Even if they don't have the usual minimum service for a paragraph 12 pension.
Correct. The only condition is that at least 1 month's contribution must have been paid into the fund. It's a vital safety net.
When does this disability pension start, and how long does it last?
It starts the day after the disablement occurs and continues for the member's entire lifetime.
And is medical proof required?
Yes, usually. A member claiming this might need to undergo a medical examination as directed by the Central Board to confirm the permanent and total nature of the disability.
Okay, makes sense. Now, let's shift to family benefits if a member passes away. This is obviously critical Social Security.
Absolutely. Family pension becomes payable from the day after the member's death under several conditions.
Such as?
If the member dies while still in service, provided at least 1 month's contribution was made. Or if they die after leaving the job but before age 58, if they had already qualified for their own pension but hadn't started receiving it yet.
And if they were already receiving their pension?
Then yes, family pension is payable in that case too. It covers different scenarios.
How much is the family pension typically for the widow or widower?
It varies. It's often linked to the member's own pension amount, actual or potential, or a specific minimum, whichever is higher. For example, it might be what the member would have got, or a minimum of $450 per month, or an amount from Table C.
But there's an overall minimum now.
Yes. The current minimum widower pension, including relief, is $1,000 per month. That's a key floor.
How long is it paid for?
Usually until the widower dies or remarries. If there's more than one widow, the scheme says the eldest by marriage date gets it first, then the next upon her death.
Okay. What about children? Are there separate benefits for them?
Yes, there's a children's pension. This is paid in addition to the widower's pension.
How much is that?
It's 25% of the widower's pension amount for each eligible child. There's also a minimum, including relief, of $250 per month per child.
Until what age? And how many children?
Payable until the child turns 25. It's limited to a maximum of 2 children receiving it at any one time, paid oldest to youngest.
Is there an exception for disabled children?
Yes, a very important one. Permanently and totally disabled children can receive the children's pension, or orphan pension, regardless of their age and without being counted in that maximum of 2 limit. Provides lifelong support if needed.
That's crucial. What if there's no surviving spouse? What do the children get then?
In that case, they become eligible for orphan pension. This is higher 75% of what the widow's pension would have been.
And the minimum for orphan pension?
Minimum, including relief, is $750 per month per orphan. Again, payable until age 25, maximum 2 at a time, oldest first, unless permanently disabled.
And if a widower who is getting pension passes away or remarries?
Then the children switch from receiving children's pension to receiving the higher orphan pension from that point on.
Okay, that covers spouses and children. What if a member dies unmarried with no eligible children?
Then, the benefit can go to a person nominated by the member. If there's no nomination or the nominee died, then a dependent father or mother can receive a pension equal to the widow's pension amount.
How does it work between parents?
If the father gets it first, the mother receives it for life after his death. However, there's a condition. If the deceased member didn't have enough service for a member's pension, but kept their membership active, the nominee or parent gets withdrawal benefits, not the monthly pension.
Right, depends on the member's service length. Good to know these benefits are guaranteed, even if the employer messed up contributions.
Yes, that's a key protection. Benefits can't be denied solely due to employer default, although the employer remains liable for those defaults.
And beneficiaries get the better deal between the old and new schemes if the member could have opted in earlier.
Correct. Ensures no one loses out due to the transition timing.
Can people who took withdrawal benefits rejoin?
Yes, by returning the withdrawn amount plus 8.5% annual interest. Gives a second chance.
And if you were eligible earlier but didn't join, you can backdate by paying past dues with interest.
Essentially, yes.
Yeah.
You're considered to have joined the old scheme upon remittance, allowing for continuous benefit accrual.
Okay, let's talk admin and payments. How quickly should claims be settled?
The target is 20 days. A complete claim received by the commissioner should be settled and paid within 20 days.
And if it's not complete?
They have to tell you what's missing in writing within that same 20-day window.
What if there's a delay in paying a complete claim?
If there's no good reason, the commissioner can actually be charged penal interest 12% per annum on the benefit amount, which could even come out of their own salary. Strong incentive for efficiency.
Definitely. Employers have ongoing duties too, right? Reporting and stuff.
Lots of them. Providing employee family details initially, issuing contribution cards, submitting regular returns electronically now who's joined, who's left, even nil returns.
They also need to keep records and help with payments.
Yes. Maintain contribution accounts, assist the board with dispersing pensions, and notify authorities about ownership details and any changes.
What about contractors? Do they have reporting duties?
Yes. They need to report monthly to the principal employer about the covered employees they've hired and provide any info the main employer needs for their own reporting.
Account numbers, are they usually the same as PF numbers?
Generally, yes, for consistency. New numbers are mainly for employees in exempted establishments who weren't in the old scheme or are new hires there.
And when you start a new job, you have to declare if you're already an EPS member.
Correct. And provide your scheme certificate if you have one. New members provide personal and family details, including specifics for those with disabilities.
Where is all the money managed?
In the employee's pension fund account managed by the commissioner. Investment generally follows the main PF scheme rules, except for the government's contributions.
Where do the government contributions go?
The money transferred from the old scheme and new central government contributions are kept invested in the public account of India.
And the fund can only be used for specific things.
Pretty much. Scheme benefits, continuing old scheme payments, and anything else needs specific central government approval. Admin costs are paid from a separate account.
Are the accounts audited?
Yes, regularly, following instructions from the central government and the Comptroller and Auditor General.
Benefit amounts are rounded.
To the nearest rupee, yes. 50 pays or more rounds up.
And the fund's health is checked annually.
Yes, by a valuer appointed by the government. Based on that valuation, the government can adjust contribution rates or benefit levels if needed.
How are pensions actually paid out?
Through authorized agencies, post offices, nationalized banks, other approved banks. The commissioner sets the procedures, forms, ID cards, etc. for disbursement and verification.
What if there are problems implementing the scheme?
The central government can issue directions to sort things out. Regional committees also advise the central board on administration.
And the scheme's performance is reported annually.
Yes, it's part of the main employees' Provident Fund Scheme annual report. Ensures transparency.
If EPS 95 is silent on something, The main PF scheme rules apply.
Correct. It acts as a fallback.
Can workplaces get exempted from EPS 95?
Yes. If they have their own pension scheme that offers equal or better benefits, there's an application process, usually decided within 6 months. If no decision, it's deemed approved. Exempted places still have reporting duties, though.
Okay, wow. We've covered a lot of ground there.
We certainly have. So just to recap this deep dive on the Employees Pension Scheme, 1995,
Well,
we've looked at, where it came from, who it's for, how the funding works with employer and government money.
right, and the different benefits, the main member pension, early pension, the disability cover, and crucially, the family and orphan pensions.
Yeah.
Plus a bit on the admin side.
It really forms a significant part of the social safety net for organized sector employees in India, provides that baseline retirement income and family protection.
Absolutely. If you, listening, want to explore further, definitely check out the official EPS 95 scheme document.
Yeah.
Especially for those tables A, B, C, D we mentioned. They have the real numbers.
Yeah, and maybe think about how these rules apply to your own situation or people you know. And of course, keep an eye out for any updates or amendments to the main act and schemes. Things do evolve.
Which leads us to a final thought to leave you with. Given how complex and long-term these pension schemes like EPS 95 are, what do you think are the most vital things individuals should really focus on now for their own retirement planning journey? Something to ponder.